We recently bought another property for £120,000, but this one didn't quite go to plan as an unexpected issue arose that changed the outcome. So in this video, I'm going to share where did we buy and why, how did we find it, what did we do to it, and the numbers. And most importantly, what happened that caused a change in direction with the property. Plus the lessons you need to take from this, especially if you're thinking about the strategy buy, refurb, and refinance. So here's the before pictures of the property. So you can see the floor plan, quite a simple vanilla 3-bed property. Really dated kitchen. There's also a dated utility room. Very tired. You've got the chipboard wallpaper, probably 1950s, 60s, kitchen units. Really out of style at the moment. Also, it's got a separate toilet from the bathroom. So you'll see it clearer with the floor plan, which I'll show. Again, you see there's a wall between the WC and the bathroom. That would need to be removed. And as we look for the bedrooms, there's no carpet in some of the bedrooms. It's got an old sliding wardrobe. It's got a functional boiler, which helps. Again, another bedroom without carpets. So the flooring will need to be changed. And we can see the back garden looks quite dated as well. So that will need to be spruced up too. Stick around because I'll also show you the refurb and the updated look. So as I mentioned at the start of the video, there's probably a few questions that are going through your mind. Where and why this property, how we found it, what we did to it, and the numbers. In terms of where and why, so this property is based in the northeast in the area of South Shields, which is literally a location situated between Newcastle and Sunderland. What really attracts me to this area is there's a lot of regeneration going on. It's got a really strong population of 150,000 people that live there, as well as thousands of people commuting in and out every single day. And in terms of this particular property, it's an area where nearly 60% of the properties are owned outright or with a mortgage. So it's a really good indicator for us that people want to live there and want to stay there long term. Plus there's really strong rental demands. So for us, it ticked a lot of boxes. So next, let's move on to how we found this property. Us and our clients every month buy several properties. So in this particular case, it was bought by one of our inner circle investor clients. They paid £120,000. Now we've been investing in the Northeast for 10 plus years, and through that we've got long-standing channels to find and identify really good opportunities through paid marketing as well as through the relationships we've got. So in this particular case, the seller inherited this property and they had not just one but 2 sales fall through. So we stepped in. It was then completed in a time period of 8 to 9 weeks. Prior to that, they'd been going through the rigmarole of trying to sell it through traditional estate agents and had obviously failed, as I explained, but it was completed in 8 to 9 weeks. So they got a quick Excel and exchange, we got a really good price. Oh, and if you're serious about starting or growing your property portfolio, but don't have the access, time, or experience to do so, then feel free to reach out. If you have as little as £35,000 or more and you want our help, my team and I can build your strategic property portfolio in the Northeast. Simply book in a strategy call with myself where I will create a personalized investment plan for you that will grow your wealth and also create a holiday fund. So what did we do with this particular property? So for our client, there was actually 3 available opportunities. So one was just as is. So do nothing to this property apart from literally around £1,000 or £2,000 worth of snags here and there, and then rent it for an estimated rent of around £700 per calendar month. The second option to our client was to do a bit of a light cosmetic upgrade of around £4,000, and it'll rent for around £800 per calendar month. Now, in this particular example, our client went with a more extensive refurb to apply the buy, refurb, and refinance to try and get quite a considerable amount of the capital out. So option 1 as is, option 2 light cosmetic refurb. So number 3 was a more extensive refurb, and our client was applying the buy, refurb, and refinance strategy in order to then get the highest of uplift to then try and pull out quite a considerable amount of their capital. Now, as I mentioned, our client went with option 3 and it was a really nice refurbishment. I'll show you some before. Let me show you the after pictures. So as you can see, it's had a really good upgrade, new bathroom, upgraded utility, new flooring. So let's go through the numbers. So our client bought this for £120,000. Now in this particular case, they didn't buy it with cash, they were using bridging finance, which is effectively a short-term finance product, which allows for quicker, speedier sales. As I mentioned before, it was completed in 8 to 9 weeks versus several months. Because they were buying with a bridge, they only needed a deposit of £30,000 and the refurb cost came to £23,570. Now when we factor in buying costs and finance costs, so stamp duty, legals, arrangement fees for the bridging, costs of buying came to £16,233. So the total cash investment, given that they were using a bridging product, came to £69,803. So with that refurbishment, an expectation of £950 per calendar month on the rent is expected from our letting agent and quoted by our letting agent. Our end price revaluation expectation is £180,000. Now we'll come back to that bit. Now we'll move on to a really key bit, which is the RROCE, which is effectively the rental return on capital employed. So what that comprises of, we've got a rental expectation of £950, but a net cash flow when we factor in the mortgage cost and insurance of just over £210. The capital left after revaluing it is going to sit around £24,000. That's what we expected. So when we factor that in, it was around 10.22% return on the rental return. So a really poignant reason why our client went with this investment was due to capital growth potential. Now the expectation is 2.5% annualized. There's a lot of regeneration in the area, a lot of regeneration in the Northeast, and there's a lot of money coming in as a result. So when we look over a 5-year window, a 5-year period, we're expecting the property price to go from the property to add just in capital growth equity of just under £24,000. So when we factor in this capital growth potential plus the rental return over a 5-year period, the total annualized rental return on capital employed is, interestingly, 29%. Staggering. So you've got 10.22% on the rental return, but when we factor in the capital growth, we're expecting annualized of 29%. So that's one of the key reasons why our client went for it. But as I mentioned, there was a really key sticking point with this property, and that was with the revaluation. Here's where it gets interesting. As I mentioned, the expectation was that the property would revalue at £180,000. But when the mortgage valuer came out, they identified the property as a non-standard construction. This was hard to identify, and it was only when they did further inspecting of parts of the loft that this was highlighted. Now, positively, the lenders were happy to lend against the property, but unfortunately, they downvalued the property as a result. They valued at £160,000, £20,000 less. Not great, not something to smile about, but surprises like this do happen, unfortunately. And it's a reminder that in property investment, not everything goes to plan. Values have their final say, and they can raise things that you might not even expect. So for example, some lenders can put additional restrictions on the value given, so the valuer actually undervalues the property, and this requires the investor to put more money in. We've seen it on this particular property case study, but we've also seen it on other properties that we've invested where properties have been downvalued, and then once we've got another lender in, they valued it at where it's meant to be. So where does that leave our client? They bought a really strong investment, but when we narrow it down, they've got 2 choices that still are to their benefit. One is to sell the property and take the profit now, or number 2, refinance it, but leave more money in the property deal than originally expected. Now, key thing here is the good news is that this area is booming. As I mentioned before, our calculation on capital growth was 2.5%, but just in the last 12 months alone, this area has gone up by 8%. Now, I'm not gonna assume that this will carry on for the next 5-10 years, but this shows that this area has the ability to even get a higher total return on capital employed when we factor in these 2 key words, capital growth. So even with this setback, our client long-term is sitting on a strong investment. This case study is a great reminder. The buy, refurb and refinance strategy can be powerful, but it isn't without its challenges. You need to factor in the possibility of unexpected severe challenges, revaluation shifts, or even lending criteria changes. If you go with your eyes open and plan for contingencies, you'll avoid nasty surprises. So if you're interested in getting help with growing your property portfolio and find the right investment strategy to fit your capital and personal requirements, just click the link in the description and book a strategy call with my team and I. So that's the story of this property. A solid opportunity, but one with a twist. The lesson is clear. Property can deliver fantastic returns, but only if you're prepared for the bumps along the way. If you're keen to see other case studies, check out these videos now.